protecting your heirs with recourse or non-recourse loans. Podcast episode 21. Welcome to Retirement Solutions for All Ages. I'm your host, Ruth, the retirement mortgage expert at NEXA Mortgage. In our last episode, we talked about home equity lines of credits, or HELOCs, how while they can offer valuable liquidity, they also come with risks, especially if not managed carefully. Today, we're going to dive into a concept that is absolutely crucial for protecting your assets and your legacy, and it directly relates to the types of mortgages we've discussed. Recourse versus non-recourse loans. These might be new words to you. This might sound like legal jargon, but understanding the difference can save your heirs immense stress, protect other assets in your estate, and simplify the process of passing on your property. It's about ensuring your wishes are honored and your family isn't burdened by unforeseen financial obligations. Let's demystify those terms and equip you with the knowledge to make smart decisions for your future and your family's future. Recourse loans, your personal liability. Let's start with the recourse. The vast majority of traditional mortgages include most first mortgages, refinances, and HELOCs. These are all recourse loans. What does recourse mean? It means that if you default on the loan, the lender can seek recourse, not only by foreclosing on the property, but also by pursuing your other assets to recover any outstanding debt not covered by the sale of your home. Your personal liability extends beyond the property itself. For example, if you have a traditional mortgage or a HELOC, as we discussed in the last episode, and the value of your home drops significantly, as we experienced in 2008, or if the sale of the home in foreclosure doesn't cover the full amount, the lender can come after your savings, other investment accounts, or even other properties you own to make up the difference. This personal liability typically extends to your estate after you've passed away, potentially impacting the inheritance you intended for your heirs. This is a critical point that many homeowners simply aren't aware of. Next, recourse loans, protecting your legacy. Now, let's talk about non-recourse loans. The most common example of a non-recourse loan in residential real estate for seniors is the home equity conversion mortgage, or HECM, a reverse mortgage. With a non-recourse loan, your home is the sole collateral for the debt. This means that neither you nor your heirs will ever owe more than the home is worth. Your other assets are protected. This non-recourse feature is a massive benefit, especially for retirement planning and legacy. When the last borrower on the reverse mortgage passes away or permanently moves out of the home, the loan becomes due. At that point, your heirs have a few clear options. 1, repay the loan and keep the home. If your heirs wish to keep the property, they can pay off the reverse mortgage balance. If the loan balance happens to be more than the home's appraised value, they only need to pay 95% of the appraised value at that time, or the full loan balance, whichever is less. This crucial protection means they are never on the hook for more than the home is worth. 2, sell the home to repay the loan. Your heirs can sell the home to repay the loan. Any equity remaining after the loan is paid off belongs to them. This is the more common scenario. If the home is upside down, meaning the loan balance is greater than the home's value, all the stress of selling is eliminated. It simply becomes the bank's problem. Most adult children don't actually want their parents' house anyway, as they often already have their own properties. What they typically want is the financial value that the home represents. If the home still has equity after the reverse mortgage is repaid, their heirs still inherit the remaining value. Navigating inheritance. What heirs face. The decision to keep or sell an inherited home, especially when there are multiple children involved, can lead to significant family disputes. I've seen this situation where multiple children fight over the inheritance, disagreeing on whether to keep or sell the home, who should buy whom out, or even who to hire as a real estate agent and what price to put on the home. Negotiating a lower offer from a buyer can add even more friction when siblings don't agree. Understanding the recourse and non-recourse nature of any existing mortgage on the home is paramount here. If it's a recourse loan and the home is upside down, the heirs might be responsible for the deficiency, which can complicate their financial situation and strain relationships. With a non-recourse reverse mortgage, this particular stress is removed. Their heirs know up front that their liability is limited to the home itself. This clarity can foster greater harmony and allow them to focus on grieving and celebrating your legacy rather than navigating complex financial and legal burdens. Your home is not just a place to live. It's the cornerstone of your legacy. Understanding the difference between recourse and non-recourse loans is critical for protecting that legacy and providing peace of mind for your loved ones. A properly structured reverse mortgage can be a powerful tool for asset protection, ensuring that your heirs inherit wealth, not unexpected debt or familial conflict. If you're thinking about your estate, your home's role in your legacy, or simply want to understand these loan types more deeply, let's connect. I'm here to help you make informed decisions that benefit both you and your family. You can reach me directly by phone at 828-888-LOAN. That's 828-888-LOAN. Thank you for joining me on Retirement Solutions for All Ages. If this episode sparked new insights for you, please leave us a review, share it with a friend who might benefit from these strategies, and hit that subscribe button so you don't miss future insights. Until next time, I'm Ruth, the retirement mortgage expert, helping you build a legacy of security and clarity.